Hey there, hi there. Hello. Hey everybody, welcome back. It's good to be back. My name's Ed Ponsi, your FX educator here on behalf of FX Street one more time. Right, with our second session of the day. And just taking a peek here at some of the charts. You can see dollar yen has not moved too much over the past half hour since we last spoke after that big decline. Big move on Euro USD, though. Looks like it's continuing. What happened here? GDP, big miss on GDP. Now, within the big scheme of things, all that does is create a wick here on today's candle, and perhaps that's who knows how that candle is going to end up, right? We don't know. But a little bit of a drop off there. Now let's take a look at the S&P. At the futures here. I think there's only one way to read this in terms of Bernanke, and S&P futures haven't moved that much on the number, which is surprising. But the only way to really read this in terms of how the Fed is looking at things is this is going to make it very, very hard for the Fed to taper. Let's take a look at the calendar for just a moment here. Now, here's the interesting thing. Yesterday, Tuesday, right, we had a blowout number in the U.S. on consumer confidence. Look at that. Looking for 75.4, you get 81.4. Way ahead of expectations. So the consumer is back, right? And it looks like the consumer's back. Durable goods beat expectations, right? So people are buying washers and dryers and cars and stuff, right? Housing prices are way up, highest reading ever on Case-Shiller. So people are buying houses, right? New home sales, way better than expected. All the data yesterday, very, very strong. How does that translate to a 1.8 GDP? It looks like the consumer is missing, right? The consumer spending component just disappeared from GDP all of a sudden. Now, this doesn't make any sense to me in one way. It does not appear to make sense if you look at this and say, well, consumers are 81.4, so consumers are happy, but they're not spending money. How do you take these and how do you rectify this? How do you take these two things and make sense out of it? The consumer confidence figure was for June of 81.4. The GDP was for the first quarter. So there's a big time difference between the two. It is very unusual for GDP to miss that badly, because we're talking about first quarter. This is 3 months ago. By now, we should have seen signs of this earlier. So, who knows? I mean, this, does it make any sense at all? But I guess if we take everything in combination, what this says is the first quarter was worse than we thought, but all this good stuff that we talked about yesterday with durable goods and housing, that's not in the first quarter. That's now, right? That's this quarter. Okay, so there's probably that's probably where the disconnect lies, is that we're talking about first quarter GDP, and really, and according to everything that I'm seeing, the reason why GDP misses so badly is really due to the consumer component just drying up. People weren't buying things at the end of the first quarter. The first quarter GDP, 1.8, actually 1.77 if you want to be precise. But the reason why this occurs is the interesting part to me. All right, the reasons why this occurred basically had to do with its personal consumption. Personal consumption just disappeared. right? And the funny thing is, well, maybe consumers are optimistic about paying off debt. Actually, it's funny that you say that, Ian, because, well, that's Lim Chong. That's exactly what I'm saying. Maybe consumers are optimistic but paying off debt. Well, that's what I said. They all went out and bought houses, right? And when you buy a house, usually right after you buy a house, you got to tighten up a little bit. But actually, that's not true, because if you go out and buy a house, I mean, I just bought another house, and I've been a big buyer of real estate during the past 5 years. You know, when interest rates have been very low, I've bought 3 houses in the last 5 years, and every time I buy a house, I gotta buy, you know, furniture and curtains, and you know, if I don't have to buy products to put in the house, I have to buy services. I have to have a rug cleaner come in. I have to have a landscaper come in. I mean, this kind of stuff, buying houses, on the one hand, you know, it's kind of a joke to say, well, everybody bought a house and therefore they're broke. So they couldn't spend money. But on the other hand, you know, you got to spend a lot of money. I'm saving. I have a big pile of receipts sitting right next to me. I bought a beach house a few months ago. And, you know, even though it came furnished, I still had to buy all kinds of stuff, you know, bedding and curtains and, you know, just a million things, and dining room table. And, you know, I'm doing my part to stimulate the economy. But, wow, you know, 1.8, I'm going to have to do more. But the thing that kills me about all of this is, and believe me, listen, what I'm saying is, especially over the past 5 years, when interest rates are low and houses are cheap, when you're making money in your Forex account or your stock account, when you're making money trading, you shouldn't just leave it all in the market, right? Every time I build up a nice chunk, I'll take a nice chunk of money out and buy a house with it every couple of years. And, you know, no matter what happens, because I've seen it happen where good traders go bad or they fall apart or they just can't, the market changes and they just can't adapt. So someday I won't be trading, but I'll still have all the houses left over from when I was trading. That's one way to look at it. That's how I look at it, right? Now, Mike, if you buy a Porsche, first of all, here's what's going to happen. First of all, the moment you drive it off the lot, it's going to drop in value. And then every time you go to the 7-Eleven, everyone's going to look at you, which is fine if you want the attention. But I think you're going to find out after a while you might not want the attention. It's like, damn, people, just leave me alone. Just leave me in my car alone, you know? So, anyway, right. So anyway, but it's different things to different people, right? To me, it's about freedom. And, you know, I try to be as incognito as possible when I'm out, you know? I don't want people to it's not I'm not like famous or anything, but even if I was, I wouldn't want people to recognize me. I mean, occasionally I do get recognized at the mall. Folks sometimes see me on CNBC, especially CNBC Asia. This is an appearance from June 13, where I called it a Pearl Jam market. Why Pearl Jam? Because instead of an even flow, there's going to be even more capital flow, because Bernanke would have to be out of his mind to taper right now. And he's not going to taper right now. Let me explain something to you why the whole tapering thing doesn't make sense the way that Bernanke laid it out. First of all, right, Bernanke his term ends in January. And he said he might begin tapering later this year. So by later this year, let's say September, October, right? If Bernanke starts tapering in September or October, he's only going to be here for 3 months, and then he's gone. He's going to be playing chess or playing golf, or he's going to be writing his memoirs and touring on the rubber chicken circuit, right? Because he's going to be done. What just happened? Can you folks see everything here? So actually S&P now jumping up on this news. So S&P is saying, how could Bernanke taper? Okay, I am now the presenter. All right. No worries, no worries. Okay, so Bernanke, how can he taper with that number? How do you do it? I mean, did he not know a week ago that GDP was going to just be a horrible miss? If so, if he didn't know that a week ago, then why did he start talking about tapering? But you got to realize Bernanke's fairly irrelevant now. He's gone. 7 months from now, he's going to be on a golf course somewhere. Okay? He wanted to quit. Here's what I think happened. He wanted to quit earlier, and Obama or someone talked him into staying and serving out the rest of his term, but he clearly doesn't want to be here. Okay? But that was, to me, how could he not know? All right? So they can't taper now, and by the time tapering does begin, he'll be gone. And guess what? Whoever follows him, whoever follows Bernanke, doesn't have to adhere to Bernanke's beliefs. I think it's going to be Janet Yellen. Janet Yellen is probably even more dovish than Bernanke. And once Bernanke's gone, now he wants out, man. He wants out. Once Bernanke's gone, Yellen's going to get in there, and she's not going to taper unless, GDP hits 5%. Okay? She's not going to taper ever. All right? And everyone came out and disputed what Bernanke said. Here's Bullard from the St. Louis Fed explaining what Ben Bernanke got wrong. Hello? Right? I mean, that's Bullard from the St. Louis Fed. And you had Fisher from the Dallas Fed. And you had the gentleman from the Minneapolis Fed, whose name I can't pronounce. And you had Dudley from the New York Fed, and they all said the same thing. You can't taper now. Right? You can't taper right now. So no, he won't be a lifer like Greenspan. He wants out. And he's made it clear that he wants out. And Obama did an interview with Charlie Rose where he spoke about Bernanke. And he's discussing Bernanke in the past tense. He's already stayed a lot longer than he wanted. That's the quote from... Some people are saying that he was basically fired on this quote, because it says, he's already stayed a lot longer than he wanted or he was supposed to. I think a lot of people misinterpreted that. Obama's not firing Bernanke. Bernanke wanted out. Bernanke already would have left. But I think Obama asked him to please stay till the end of your term. Okay? Jim Cramer for chairman. That would be interesting. Absolutely. Rocco says, what's with hitting 6.5% unemployed and taper then? Well, I think the person from the Minneapolis Fed actually wants 5.5%. But you got to understand, everyone's worried about what Bernanke said this, Bernanke said that. Bernanke's out of here. He's a lame duck. He's gone. Okay? And I'm much more concerned with what Janet Yellen thinks than I am what Ben Bernanke thinks. Because Bernanke, mentally, I think he already checked out. Sometimes it seems that way. Did you happen to see when Bernanke was telling a lot of jokes earlier this month? Do you ever remember this happening before? Does Bernanke strike you as being a very funny guy? He is actually hilarious. I can't wait to read his book now. No, he's not going to be a lifer like Greenspan. And, he's still a young man. Enjoy your life, right? And so anyway, he actually was at Princeton, where he graduated from Princeton, giving a commencement speech a few weeks ago, and he told a lot of very funny jokes. And he's never done that before. It seems to me like he's beginning to relax a little bit. And that's That to me is very interesting. It seems to me like he's beginning to relax a little bit, like he knows it's over. He knows this is it, and he's going to enjoy his last days in office. He's done. Okay. All right, so let's get back to the charts. Anyway, S&P 500 likes it, apparently. Right? Actually moving higher on this news. Why? Because it means that they're not going to. Nobody's going to take away their candy. Nobody's going to take away their punch bowl. Okay. And so more no tapering, more money. This is probably going to go higher. I don't think Bernanke can taper with a 1.8 GDP unless, he either got this one wrong, which wouldn't be the first time. I'm not being critical here. I think he's actually not done a terrible job, but he's gotten stuff wrong before, hasn't he? He sort of missed that whole subprime thing. Remember that? Subprime is contained. Anybody remember this? That's definitely one of his greatest hits. Subprime contained. March 2007. Bernanke said subprime was contained. And back then, where were we? Here. He didn't see this coming. He didn't see the housing market falling apart. Right? By the way, guys, I was invited to be on again tonight, but I don't think I'm going to make it up there. It's going to be. I'm not in the New York area today. I'm at one of my other places, and it's just not going to be possible. So I was invited up there again tonight, but it's like I'm 100 miles away from New York right now. Got to understand a few things too. If you understand anything about how this business works, right? Let me explain to you something about how this business does work. Now I cannot get past this thing. Just a second. So Bernanke thought subprime was contained. He did not see a recession coming. He did not see economic weakness coming. And so he's made a few mistakes. I think, but like if you want to take it into account also, this guy at the worst possible time became the Fed chairman. He became the Fed chairman right before everything went to hell in a handbasket, right? What is your trading record, annual percent, etc.? Okay, you got to understand something. This is my Twitter account, gang. Follow me on Twitter, right? I'm a Series 3 registered CTA. What does that mean? I'm registered with the CFTC. I'm registered with the NFA. I can't go into a chat room with I don't know how many people are in here and say I make this much money or that much money because that's considered advertising. And I wouldn't do it anyway because it's just plain bad form. Usually the people that are screaming about their track record are talking about, yeah, I was up X percent between March 8th and April 22nd or something stupid like that, whereas real traders have to operate on an annual, quarterly, monthly basis. I will tell you this. It's not my goal to make, outrageous returns. I've been in this business since the mid-90s. And I just want to be steady Eddie. I just want to make money for myself and for my clients. I don't have to knock it out of the park every time. I just want to grind it out, make money, and be steady. In other words, you don't want your P&L. The guy who says, yeah, I'm up 40% this month, he's going to be down 100% some month in the not too distant future. So don't be sucked in by that nonsense, okay? But if you understand how it works here, I don't know if you're in the United States or not, but in the U.S., if you're actually a registered trader, and CTA stands for Commodities Trading Advisor. So I'm allowed to buy and sell for clients. That includes commodities, right? Gold, silver, etc., but it also includes Forex. They lump Forex in with Commodity Trading Advisor. James says, I was up 300 in a month and then blew it all. I think we've all done that at one time or another. I mean, I went through my early days where, the truth is, I would have probably never been successful except for one thing. I started out at the beginning of a huge bull market in stocks because I didn't know what I was doing. I just kind of started threw my money into the ring. And usually when you do that, you get chopped to pieces. But I just happened to start in 1996 in the stock market, which was the beginning of the biggest bull market in history. And I made a lot of money in that market, but I also gained a lot of experience. By the time that bull market was over, I had 4 years of experience as a trader, and by the time when the bull market began, I had no clue what I was doing. I would freely admit, I had no idea. By the time it ended, I had a good idea what I was doing. Okay? I'm a charter holder of a CFA designation. Well, no, you're if you're a charter holder of a CFA designation, then you know that it's not the same thing. Certified financial analyst, CFA, and that means that you probably understand. You could probably speak at great lengths about balance sheets and things of that nature, stock valuations, etc. Right, using more of the fundamental side. Which is great. And something? I'd love to be a CFA. If I can only have the time, I've actually passed tests for the CMT, but I'm not a CMT. You're not a CMT until you finish passing that last test. CTA means that you can place trades for other people. It means that I can take people's accounts under my wing, and I can legally place trades for my clients. That's what a CTA is. CMT is Chartered Market Technician. That's very different. That's like a technical version. That means you're a chart expert. I don't have a CMT yet, but I've actually passed the first test back in April. I didn't even study. I mean, it was really easy. CFA is something I'd like to pursue too, but there's only so many hours in a day. But a CTA has nothing to do with technicals or fundamentals. CTA means I can trade for you. CMT means Chartered Market Technicians. It means that I've passed tests and I can read charts. The truth is, you don't have to pass tests to read charts. I mean, I think anybody can see, that this is a head and shoulders, and there's no test that's going to change that, right? It's definitely not necessary for me to be a CFA or even a CMT, but it's fun to test my knowledge, and I do, I rub shoulders with a lot of people who are CMTs and CFAs. I don't really need to be either, but I just love to learn stuff, and I love to explain stuff, and that's why I'm on here. That's why we have so much fun in this room. But yeah, I would love to pursue. I hear CFA is really hard. I mean, CMT is not hard. CFA, I hear, is very, very hard. That's my understanding of it. But I would enjoy learning it, though, because I just love to learn stuff. Okay. Wow. Holy cow. Let's get to some charts here. Time just flies by in this room. I really enjoy interacting with everyone, and I hope you enjoy it too. I think it's going to make you a much better. It's not necessarily going to make you a better trader, but you'll at least you'll understand what people are getting at. We do this twice a day, actually. Not every single day, especially in the summer. I've lightened up my schedule a little bit for summer, but sometimes we do it 10 of these a week. This is fun for me. I mean, this is premium, and I just want you to know, why do I do this every day? Because if I wasn't saying this to you, I'd be saying it to someone else. And right, I'm talking about this stuff anyway. I have to bore the people in my house with this stuff. If right, so anyway, what do you make of this chart? I'll tell you, broadening formation is probably what I would say. Higher highs, a lower low. Broadening formation is probably how I would describe British pound right now on the daily chart. However, if you want to get a little more micro, and something, we don't have to do all our trades off of longer-term charts. If you want to get a little more micro, you could say that in the short term that we're in a downtrend here on British pound. One of the things that I like to do, there's the hourly. You can see we have a little line drawn in here already at 155.70. Was a big, it was a major level. And you look here, we had the nice support here. We had resistance back here. And as long as you're under that level, what do we have on the chart? High, lower high, lower high, lower high, right? Low, lower low, lower low, lower low, right? Lower highs, lower lows, right? If I draw this in, just roughly, it could look something like this. Yeah, but it's unfortunate. I can't really talk about my returns. It would be considered advertising in this room, and that would put me in violation. But I will tell you this. You're not going to make your eyes pop, but I'm steady. I just try to be steady and profitable, and that keeps me happy. That keeps my clients happy. What do you think of this chart? Right? You have a downward channel on cable. And I think in this case, you got to sell a rally above 154 as long as it's, and where would you put your stop, right? I would say maybe above this channel line. I think the stop would go right about here. All right. One of the things I'll use in a case like this, I could go to a shorter time frame and use, for example, RSI. And if this thing pops up and it becomes overbought on short-term RSI, I'll wait for that to turn. When it turns and drops, I'll short it. And you can basically move your stop down, trail it down above these peaks, and keep it outside of the channel line. And something like that might be a good plan for British pound right now. Cable is not as over. So like, the obvious choice to short is everyone's thinking, oh, short Aussie. Well, first of all, Aussie's already gotten killed, and you're going into a lot of political turmoil there right now. That could mean a bounce, even if it doesn't, even if it's not really justified. Sometimes the markets will throw a bounce in there just because people are short, right? Now, when we look at things like, for example, in this room, we'll look at things like the COT report, right? Be sure to follow me on Twitter too, folks, at Ed Ponsi, P-O-N-S-I, right? Take a look at this, CME COT report. And I'm going to hang with you just a little bit longer here. Well, let me know if I'm getting in anybody's way. I'm going to do a few extra minutes here. We have a lot of people in the room. You take a look at stuff like the Australian dollar. And again, this is updated every Friday, so this is not new data. But it certainly would seem that there's about a 3-to-1 ratio of short to long in the futures market. That's for non-commercials, right? Those are big speculators. Commercials we don't care about. They need Australian dollars to do business. Okay? Non-reportable, we don't worry about them because they're actually, even though some people will tell you that these are the guys to watch because they don't know anything, that's not true. Individual traders have become a lot smarter over the past 10 years or so. And it's no longer the case that these folks don't know what they're doing. But I will tell you this. The non-reportables, it's about 3.5 to 1, short to long. The reportables, it's about 3.5 to 1. And that may not sound like a lot, but that's actually more. That 3-to-1 ratio on the short side is higher than it's been in years. Higher than it's been in years. there are a lot of Australian dollar shorts, and therefore, in the speculating community, not in the commercial community, but in the speculator community, because the market is overwhelmingly short, I think it's very dangerous to short the Australian dollar down here. Okay? These are the guys that we look at. And it's like the non-commercial, the big speculators. 3-to-1 short to long, actually 3.5-to-1. It's like a ship, right? If everybody runs to one side of the ship begins to lean, right? And when the ship begins to tilt, just imagine you're on a boat, right? And everybody runs over to one side of the boat to look over the side. And, I don't know, there's a whale sighting or something, right? And the boat begins to lean and tip just a little bit, right? What are you going to do next? When you feel that boat beginning to tip and lean, what do? You run to the other side of the boat. All right? James knows, right? Yeah, as far as and so it begins to change. So what I'm saying is everybody's leaning on one side of the boat here. The market is overwhelmingly short. They're all leaning one way. They're going to get caught short. They're going to have to cover. There's this disparity here with the commercials. First of all, the commercials are overwhelmingly long, but they're not speculating on the market. Commercials need to be in an Australian dollar position, either long or short. Why? Well, maybe they sell products to the U.S. Maybe they have loans that are taken out in U.S. dollars. There's a lot of reasons why commercials might need to be involved in an Australian dollar position. But the important thing to understand about the commercials is they're not speculating. Okay? They're just in there because they have to. If I sell, iron ore to South Africa, or that would be stupid. Why would I sell iron ore to South Africa? If I sell oil to Japan and I'm in the U.S., if you're a Japanese company and you buy oil from a U.S. company, you would be very concerned about the exchange rate between the U.S. dollar and the Japanese yen. You would hedge yourself so that if the dollar goes up, what does that mean? It means the price of your oil goes up if the dollar goes up. So you don't want the dollar to go up. So what do? You go long U.S. dollar, and that way if the dollar goes up, you make money on the hedge, and that keeps you in business. That's why these guys are in, to stay in business. They're just hedging their commercial positions, just like James just mentioned, right? This is exactly what's happening. So we don't care what they do. But the reason why there's a disparity is because you see these guys over here, they're buying from someone. Right? Every contract, there has to be a long side and a short side. So, if I'm a speculator and I want to go short, who's going to sell it to me? Probably this guy over here. Okay? And that's, you'd be surprised how many people start out here, right, and end up over here. One guy would be the gentleman who, the owner of the Boston Red Sox, right? He was a farmer. His family owned a farm. He had to hedge stuff, crops, right? And so he was pretty good at math. He was good with numbers. And he became pretty darn successful in the hedge fund world. I'd say if you can afford to buy the Boston Red Sox, you're probably pretty successful in the world of hedge funds, right? So, it's a U.S. baseball team, folks, for my friends who are not from the U.S. And that's, probably a $200 million investment. All right. So anyway, it's amazing, but that's how it works. So I look at the non-commercial positions. That's generally how I operate it. The thing that was probably most interesting recently had to do with the yen. The yen, the market was overwhelmingly short Japanese yen as of the last reading. Overwhelmingly short the Japanese yen. And again, that's about 3.5-to-1 ratio. And so it's sort of a contrarian indicator. Like, nobody who's short the yen is going to be short forever. Nobody who's short the Australian dollar is going to be short forever. Shorts are future buyers. They're going to close that position someday. They're going to close that position at some point. So I see this as a lot of potential buying in the Japanese yen. It's like, if you, it's like fuel. It's like somebody poured gasoline, but nobody's lit it yet. Maybe it's not going to be lit, or maybe it gets lit. And what do I mean? What would happen? The yen would get a lot stronger because there's 85,000 yen contracts short, and all of them are going to cover eventually. Right? So a little bit of yen strength might create some of these guys begin to cover. And when they cover, what are they doing? They're buying the yen, and that creates more yen strength. And more yen strength costs more of them to cover. And on and on and on. Okay? All right, folks. Hey, listen. I really enjoyed hanging out with you. I hope you enjoyed hanging out with me, too. Yeah, that would be yen against the dollar. By the way, all these are against the dollar. This is the CME in Chicago. So you could actually, look at this on anything. I mean, the ruble is basically 1-to-1. There's no edge there. But you could even look at this in terms of cattle, butter, lumber, lots of different things. Okay? So listen, we're going to be back again later this week with more sessions and lots more sessions in the future. I hope some of you folks will get to see you in here on a regular basis. Again, my name's Ed Ponsi. Keep an eye out. You'll probably catch me on CNBC Asia sometime later this week or early next week. I'll probably be on early next week instead. And follow me on Twitter, at Ed Ponsi. I'd really appreciate to see you on there. And until then, until next time, everybody have a fantastic day. Be careful out there. I'll speak to you again very, very soon. Take care.